Welcome back to the Deep Dive. Today, we are really digging into Lam Research Corporation-LRCX after their Q3 FY 2025 earnings call. You know, they're such a critical player in the whole semiconductor ecosystem, almost literally building the factories that build the chips.
They really are. Lam Research is right there at the core of advanced computing. They're the go-to for deposition and etch, which are just fundamental for modern chip designs, you know, enabling everything from HBM to the latest NAND.
So our mission today.
Well, we need to sort of square the circle, right? They had this fantastic quarter financially, but there are these geopolitical issues kind of clouding the view for 2026. We need to break down the beat, the AI story, and the margin picture.
Okay, let's start with those headline numbers because, I mean, they looked really good on the surface.
Yeah, they did.
Non-GAAP EPS, $1.26. That was comfortably above the $1.22 consensus. Yeah. And revenue, $5.324 billion, beat by about $100 million. So yeah, clean beat, top and bottom.
A clean beat, absolutely. But what I found even more interesting was the efficiency underneath. They hit record profitability levels.
Like the gross margin.
Exactly. Non-GAAP gross margin hit an all-time high, 50.6%. That's 30 basis points up from the previous quarter.
Wow.
And non-GAAP operating margin was right there too, another record at 35.0%.
Okay, wait. Record gross margin, 50.6%. With all the, global stuff going on, tariffs, uncertainty, how did they pull that off? Seems kind of counterintuitive, doesn't it?
It does. And that record margin, that's kind of the key that unlocks this whole story.
Yeah.
It really highlights their significant exposure to some very high margin business in one particular place, China.
Oh.
We really have to dive into the revenue mix to get a handle on the challenge they're facing right now.
Okay, let's do that. So the mix in Q3, September quarter, heavily weighted towards logic and foundry, I assume.
That's right. Foundry systems absolutely dominated. Hit a third record in a row, actually. 60% of their systems revenue.
60%.
Yeah. Memory was 34%. That breaks down to about 18% NAND, 16% DRAM. Mm-hmm. And a lot of that DRAM spending is clearly being driven by, the big investments in HBM production.
Makes sense.
But the real lever financially, the thing that drove that record margin, was geography. China came in at a huge 43% of total revenue.
43%. That's massive. And that was mostly domestic Chinese customers, right? Buying maybe older generation tools that carry better margins for Lam?
Generally, yes. And now that specific stream of high margin revenue is, it's hitting a bit of a regulatory wall.
Okay.
Management is now, proactively building in the impact of this new 50% affiliate rule restriction. It affects certain domestic Chinese customers.
Right. Explain that rule a bit for the listener.
Sure. Basically, it restricts Lam from selling certain things to specific Chinese companies that are seen as having close ties to the military or government, even if the tools themselves aren't the absolute latest tech. It's a pretty clear line the U.S. government is drawing.
Got it. And the financial hit from this regulatory normalization?
Well, the immediate impact, they think, will be around $200 million lower revenue in Q4.
Okay.
But the bigger structural hit comes in 2026. Management's forecasting this restriction will cut their calendar year 2026 revenue by about $600 million.
Oh, man, $600 million, just poof, gone from the 2026 forecast. That's a major adjustment.
It is. It's a huge number to absorb. And they expect the China mix overall to drop below 30% in CY 2026 because of it. That's a really rapid, significant shift in where their revenue is coming from.
Okay, so that directly explains the margin pressure then. Let's talk Q4 guidance. Even with that China hit baked in, the guide seemed okay, actually above consensus.
Yeah, the top line guide was solid. Revenue $5.2 billion plus or minus $300 million. And EPS $1.1 plus or minus $0.10, both above what the street was looking for.
But following the logic, that record 50.6% gross margin can't hold, can it?
Exactly right. The gross margin guidance drops quite a bit sequentially, down to 48.5% plus or minus 1%. Ouch. And that drop, that compression, is the direct result of losing some of that super high margin China mix, plus the ongoing tariff impacts. So the market's basically being told, expect lower margins, even while the bigger strategic picture looks pretty good.
All right, let's pivot then away from the geopolitical pain and towards the thesis protection, right? The long-term AI and WFE growth story. This is where Lam's tech specialization really comes into play.
This is the necessary offset, definitely. And management actually gave a helpful number here. They estimate that for every $100 billion someone invests in new data centers.
Yeah.
That translates to roughly $8 billion in WFE spending. And because AI and HPC chips are just more complex to make.
Right, more steps.
More steps, exactly. That spending flows disproportionately to specialists like Lam, especially in deposition and etch.
And that complexity is driving specific tech wins for them, particularly in memory. We heard good things about NAND upgrades for those big enterprise SSDs. That $40 billion upgrade TAM they talked about before is apparently accelerating.
It is, faster than they thought. And Lam's tech is right in the middle of it. Their Halo Moly ALD, that's atomic layer deposition tool, is apparently the tool of record for 3 straight memory nodes at a key customer.
Why is ALD so critical there?
Well, think about stacking hundreds of layers for 3D NAND. You need almost atomic level precision to deposit those layers super thinly and uniformly, otherwise, signals leak between them. ALD provides that control.
Okay. And beyond NAND, what about Foundry and DRAM for AI, HBM specifically?
Oh yeah, they're locking down some key spots. Their ether dry resist EUV patterning technology is ramping now in HBM production lines.
And what does that do exactly?
It basically allows chip makers to use a lower dose of that very expensive EUV light, more than a 10% reduction, they said. That's a huge gain in factory throughput and cost, really important for scaling up HBM.
And they're also dealing with fundamental physics, right? These low-K ALD films.
Yeah.
Why are single wafer tools a big deal for that?
Because everything's just getting so incredibly tiny. When transistors and wires shrink below, say, 5 nanometers, the signals start interfering with each other. It's called capacitive coupling.
Ah, like crosstalk.
Exactly. So these low-K films act like super specialized insulation between those tiny wires. And Lam's single wafer approach gives much better uniformity than older methods. So they're winning business there in advanced logic and foundry.
Okay, and one more thing they mentioned, moving beyond the standard 300 millimeter wafer. That sounds like advanced packaging for these giant AI chips.
Correct. Chip integration needs are pushing towards larger formats. Lam's investing in panel-level packaging. They specifically called out their Sabre 3D plating and etch tools for this. It's about getting ready for the next wave of throughput demand when chip assemblies get much bigger than today's wafers.
Okay, so pulling this all together, the long-term picture still looks pretty positive, but there's a big asterisk on the timing, isn't there?
Absolutely. Calendar year 2026 is still expected to be a growth year for the whole WFE market, driven by AI. But, and this is key, management was very clear that growth is going to be heavily second-half weighted.
And that H2 weighting, that's because the restricted China revenue is basically pulled out of the first half numbers, right? Plus, they kept mentioning other constraints, like clean room space.
Exactly. That timing is a direct result of the China mix shift we talked about.
Yeah.
And yeah, they mentioned external constraints like clean room availability, potentially limiting just how fast customers can actually install new tools, even if they want them.
Something for you, the listener, to factor into your models.
Definitely.
Yeah.
But structurally, the takeaway is LRCX has really tightened its grip on deposition and etch, the 2 processes that become more critical as AI and HPC drive complexity up.
We should also quickly mention the stabilizing force, their CSPG business, the services arm.
Right, the Customer Support Business Group. Services, spares, upgrades, it's their resilience engine. Did about $1.8 billion in the quarter. It's incredibly consistent, grown every single year since the Novellus merger, except one. And importantly, it boosts their overall operating margins. It's a great shock absorber.
And they're still returning cash.
Oh, yeah.
Right.
$1.28 billion back to shareholders through buybacks and dividends this quarter. And they reiterated that plan to return at least 85% of free cash flow over time. Solid capital allocation.
Okay, so if you're watching Lam closely over the next few quarters, what are the key things to track?
Okay, number 1. Watch that gross margin trajectory.
Yeah.
Q4 and into Q1 26. Does that 48.5% floor hold? Or does the speed of the China mix shift pull it down further?
Right.
Number 2, keep an eye out for updates on HBM DRAM buildouts and those advanced packaging milestones. Those are your real-time indicators that AI spending is turning into actual Lam orders.
Makes sense.
And finally, look for the quantification of that second half 2026 WFE rebound. We should get much more color on that, I expect, on the January earnings call.
Perfect setup for our This Is Not Financial Advice segment, because this call really had that split personality, didn't it? Record results, then this big margin warning, but all against this backdrop of a huge AI growth wave. So I've got a paired trade idea. Maybe outrageous, maybe plausible.
Okay, lay out the core idea first.
All right, the fundamental thought is, the market right now is really focused on the near-term margin pain, which, as we discussed, seems kind of temporary and quantifiable. That $600 a hit is a one-off adjustment, really. But arguably, the market is underestimating the sheer scale and the acceleration of that AI-driven WFE demand that really kicks in, likely in the back half of 2026.
Okay, I follow the narrative. How would you try to, trade that split view?
So a paired trade, two parts. Short term, kind of bearish. You bet on the December quarter gross margin actually coming in below that 48.5% guide.
Okay.
The thinking is the market still hasn't fully priced in how fast that high margin China revenue is dropping off. Maybe you'd execute that selling some near-term vertical call spreads, something like that.
Short the immediate margin pain. Got it.
But at the same time, the long-term bull side, you buy deep in the money, long-dated call options, OFs, on LRCX, maybe targeting late 2026, early 2027.
Right.
The rationale there is that the China headwind is just a reset. Once that noise fades, the underlying growth from HBM, that accelerating NAND TAM, it drives Lam's earnings way beyond what analysts are forecasting today. So you're kind of hedging the short-term geopolitical noise while staying long the multi-year tech cycle.
That's actually a pretty sharp way to approach a mixed signal like this. Historically, the market has sometimes overreacted to Lam's mixed shifts or tariff impacts, and the company usually finds a way through it. I do agree the core multi-year story, driven by just more deposition and etch needed for every advanced chip, that remains really strong for LRCX. Using those long-dated options could be a smart way to isolate that tech thesis from the immediate noise.
Okay, so let's recap this deep dive. Lam Research. Phenomenal profitability in Q3, hitting records. But they've now clearly flagged an unavoidable margin headwind coming from that geopolitical shift, moving away from high-margin China sales.
Right. But crucially, their strategic tech wins in areas essential for AI HBM, advanced packaging, next-gen NAND, mean that long-term growth story still looks really solid. It's tied directly to that exponential rise in computing complexity.
So the final thought we want to leave you, the listener, with.
Yeah, as you track this growth heading into 2026, think about this. What's ultimately going to be the bigger bottleneck for AI-driven WFE growth next year? Is it going to be physical limits, like the clean room space constraints management kept bringing up? Or is it the equipment supply chain itself?
Interesting question, because the answer probably dictates the pace for the whole industry.
Exactly. Something to chew on.
All right, a fascinating structural question to wrap up. Thanks for joining us for this deep dive.
Thanks for listening.